Welcome to the Business with Beers podcast. This is the place where we help entrepreneurs expand their business, build their wealth, and generate passive income. I'm your host, Brian Beers, an entrepreneur who's on a mission to inspire growth from everyone around me. Remember that you need to take the actions others won't, and you can live the life that others don't. Please be sure to check out my weekly newsletter that now drops every Thursday. It includes one quote, one tweet, one podcast recommendation, plus some business and investing insight from me. It's short and it's sweet. My goal is to provide you with just a couple gold nuggets to help inspire your growth. Go to brianbeers.com to subscribe. Hello, everyone. I'm excited today to bring you Dr. Vasu Kakarlapudi, who's a trained ear, nose, throat, head, neck surgeon who helps busy physicians achieve financial freedom by investing in real estate without the headaches of being a landlord. Welcome to the show, doctor.
Glad to be here, Brian.
Awesome. Cool. So, to start, can you give us an idea of your journey? You can start at 18 years old, or you can go back sooner if you want, and just how you got into medicine. And then I really want to talk about this pivot of how you went to, go about getting into the real estate business.
Yeah, absolutely. So I grew up in Kansas City, son of two Indian immigrant kids, two immigrant parents rather. And like a lot of other kids growing up in the 80s, I was addicted to baseball. And the harsh reality occurred to me when I was trying out for the high school team as a freshman and couldn't make the high school team. So I realized I wasn't going to be able to earn a paycheck playing baseball. So I had to kind of pivot to things that I was good at. I was good at school. And so naturally, being a brown kid in the Midwest, growing up in the 80s, if you were good in school, you're going to be a doctor or an engineer. And I chose medicine. Fortunate to get into a program in my hometown of Kansas City. So I went to college and medical school over there and did my residency in ear, nose, and throat surgery in Baltimore. Really kind of like ENT surgery because it was very delicate, meticulous, precise, kind of going from one landmark to another landmark. And so that really attracted me and my innate personality. From there, kind of moved to Louisville, Kentucky to start a practice. Got married, my wife and I. My wife's a dentist. And so she and I were blessed with kind of a nice, healthy paycheck, but still trading time for money, and kind of looked around to see, okay, well, how could we leverage our career earnings and gain freedom to be able to do the things that we want to do and work on our own terms. And the obvious place to go was real estate. And so I've been hooked ever since. Okay.
So what does, what does your real estate portfolio look like? Like what type of assets do you guys buy?
Yeah. So initially got into the single family, like most people started, because the barrier to entry is pretty low in single family, but kind of quickly realized that toilets and termites create a lot of hassle and it's hard to scale. So quickly kind of moved on to a wide variety of real estate asset classes, from medical office, which was a natural instinct for us because given our profession and in medical office, and built a surgical hospital and senior care, retail, grocery anchored retail in particular because of its Amazon recession resistant kind of asset nature of that. And then most recently, over the last probably 10 years, primarily focusing on multifamily, just due to the supply-demand imbalance and the strong demographic tailwinds with housing in this country. Okay. Yeah.
And then do you invest kind of yourself? Is it like, do you raise money, from other investors? Primarily doctors, it may sound like. Where does the capital come from?
Yeah, it's a little bit of both. I like to always beta test it myself before I raise capital from friends and family. So certainly have kind of, done a lot of the background work in investing in an asset class myself, risking my own money, learning all the tricks of the trade and perfecting that before we raise capital from other folks. But, never really went into this to try to raise capital. It was more along the lines of friends and family that we helped make money for. They're like, oh, you should, we want to do more. We want to do more and more. And so out of that need and really kind of saw a lot of our peers who were still, had a lot of negative emotions given the negative secular trends of practicing medicine. And we're kind of looking for an antidote to that. And real estate is the obvious antidote in our humble opinion. So now we do raise capital primarily for multifamily because it's the most demographically based, least economic cycle sensitive asset class within commercial real estate.
Okay. And so how many doors do you own? How much is it worth? Where are they located? What's it look like?
Yeah. So we are operate a multifamily syndication fund. So we provide diversification for investors across multiple assets. So we've got 3 assets in the fund, aside from our own personal portfolio and a few small groups of friends and family. So we started the fund about a year ago, a little bit over a year, about a year and a half ago now, and have 3 assets in that. The most recent one was a $64 million addition that we had in Wiley, Texas, which is a suburb just east of Plano in the DFW area. Another asset in Fort Worth, and then prior to that, another asset in Northeast Atlanta. So, yeah.
How much in total?
So we've acquired in our fund about $200 million worth of assets in our fund right now.
Oh wow, that's pretty impressive. Those are large properties. I mean, 3 assets, $200 million. I mean, those are big boy properties there.
Yeah. These are big.
How'd you like make the jump? I mean, because part of that's the mindset stuff, right? You go from a single family door, it's super low stress, not low stress, low barrier of entry. Like you understand it, to like, holy moly, we want to, buy $200 million of real estate with other people's money. Like, what does that like internally look like? And then obviously like externally, what does it look like?
Yeah, I mean, internally, it's just about making 2% improvements every time you do a deal. So, the way you climb a mountain is one step at a time, right? So, this didn't happen overnight. Again, I mentioned that, we started shortly after started practice in 2003. So really started investing in real estate in 2005. And certainly didn't start off with these larger projects, but we start off with smaller projects and really built a team. So real estate's a team sport. Yep. And so I was very fortunate to have a lot of mentors along the way. And I kind of did, the medical colleagues on your listenership will probably understand the concept of residency, where, you basically spend time with professors who do what you do. And over a period of time, you kind of learn some skills, and it's on the job training essentially. And that's what I did with real estate. So, fortunate to have a lot of mentors along the way who I was able to kind of ride along with. And I said, hey, I want to learn your business. And it's amazing how if you're humble and energetic and people want to help you. And so that's really essentially what I was able to do, was to learn from the experts. And again, you take one small project, and then you learn from that, and then refine your process, and then you expand to the next project. And it's just a sequential. It's just like compound interest. Your skill sets. And
so it's like one property to the duplex, to the like 5, to the 10, to the 20, to the 50, to the 100, to the now whatever. I mean, hundreds of doors.
You got it. And it's about building a team. So, again, real estate, as we mentioned, is a team sport. So we've got a team behind us that's done, north of $800 million worth of transactions that have been, profitable throughout various economic cycles. So it's about, finding your core competency and then building a team around you to complement your skill sets.
So what does that team look like for you? Are they all full-time people like that are 100% on your fund? Like, what are the different roles?
Yeah, exactly. So you've got to have folks that help you with finding deals and building relationships with brokers and other investors, and then putting the deal together from a financing perspective. You need an asset manager, property managers, accountants and CPAs, and all that other stuff. Yeah, just like running any other business. It's not an individual thing.
And so, what's your role in the organization?
So my role in the organization, I'm kind of transitioned now to primarily being the visionary in terms of communicating a vision to the rest of our team members. And also my core competency, what I love doing more than anything else is talking to investors. So I love talking to peers, surgical peers, physician peers, healthcare peers, or other business owners who are looking to learn more about real estate and find opportunities where they can invest alongside us. Because again, I wanted to have malignant alignment of interest, and so we definitely align our interests so that it gives folks an opportunity to invest alongside us. So you're putting
capital into every deal.
Yeah, we're the largest investor typically in every deal. So people can rely on the fact that not only is our reputation and our guarantor status and on the line, but so is our own personal capital. And so, I love this quote from Charlie Munger. He talks about show the alignment, and I'll show you the outcome. Yep. And so that's what we try to live.
So then, I guess you and some other partners that are also doctors that are kind of the owners of the managing members. Is that what it looks like from a leadership perspective?
Yeah, leadership perspective. We're the only physicians. The other guys are, primarily, not practicing medicine. So, okay. and I practice medicine on a part-time basis. So
yeah, that was going to be my next question is how do you allocate time? I guess I'm sure it's evolved over the years from a 10% to 15, 20, maybe you could tell me, but, and then what does it look like today in terms of your allocation of time?
Yeah, right now I'm probably about a 60-40. I still like practicing medicine about 60% of the time. I do real estate about 40% of the time, but you know how it is as a business owner. You work evenings and weekends, and so real estate's really a passion. So I don't really view it as work. So I don't really count the number of hours I do in real estate. But so for example, today's my real estate day. So I'm in the home office, in my house, talking to guys like you, entrepreneurs and other investors, and
okay.
Looking at new deals.
You do a lot of the fundraising, like investor relations, initial calls to educate. Is that what?
Yeah, absolutely. And then also involved in, the weekly meetings with our property managers and
yep,
with our asset management team, looking at the different assets and kind of, vetting our processes and our models to figure out, hey, does this make sense for us? And so it's a little bit of both, a little bit of all the pieces. But okay. Yeah, primarily I love talking to investors.
So how do you then, go into that subject. So you're talking to a doctor or someone in tech or someone who's got, almost all their money in the stock market, because that's what they've been taught to do, that it's like, that's where you put your dollar cost average into Vanguard or whatever you do. And it's safe and it's secure. And it's like, it's what you do. And the real estate's like risky, or that there's all these issues, whatever, right? There's all these negative connotations. So how do you go about, like, I guess, what's your philosophy of trying to help pivot and break that kind of mold, and then to believe in the asset class to invest?
Yeah, I mean, I think most people who are in the scientific fields, really kind of follow the data, right? And so that you look at the data and you think about the more diversified your portfolio can be, the lower your risk, even with the same risk profile. And so that's what I tell folks. And you kind of look at institutions like Tiger 21, who's another high net worth group of mastermind group of investors. And, they allocate the plurality of their investment portfolio to real estate. So 27% real estate and 25% in the stock market. So, people who are trying to aspire to have freedom and fulfillment in life can really there's a proven path. And just relying purely on the stock market, an equal blend of stocks and bonds and growth and, various different types of stocks and mutual funds just isn't the way that most people gain financial freedom. So it's really showing them the data and just kind of understanding that, hey, while stocks and bonds are part of your portfolio, if you diversify and put a portion into hard assets like real estate that's really safe, you can lower your risk and increase your return and gain tremendous amount of tax advantages, which we can certainly talk about in depth as well.
So then, and I've had some other guys, who've done apartment syndications and things like this on as well. And so, and from your perspective, why would they invest with like your guys or one of these other ones versus, if they invest in a REIT or something that's like a publicly traded thing if they want real estate exposure?
Yeah, I mean, I get that question a lot. Actually, REITs have become very popularized because they've got a lot of marketing dollars behind them. And unfortunately, REITs, you're actually investing in companies that buy real estate, right? And they're subject to the whims of the ebbs and flows of the stock market. So the volatility in REITs is huge. You don't get the same tax advantages. If Elon Musk tweets something or Trump tweets something or Biden has a tiff with Congress, all of a sudden that can affect your
the price, the public but markets. Not the underlying asset, which doesn't change with the tweets.
Exactly. Exactly. When you're in a syndication, your valuation is primarily based upon the P&L of your individual business. And so all of these short-term, cycles from political news and pundits just saying one thing or the other can affect your valuation. Whereas when you're running a business, sure, there are, you are sensitive to the economic cycle for sure, but you're more sensitive to the demographic cycle if you're focusing on the type of asset class that we focus on. And plus, the other thing is tax advantages. So, when you are a fractional owner in an asset, all the pass-through benefits as a business owner flow through to the individual investors. So those are some of the things, but we could talk about that for ages, Brian.
So then someone says, all right, I'm game. I get this. I want to go direct. How are some of the ways they can go about vetting both the operator, which is someone like you, and then what the asset is, or in this case, a fund, which is going to be like a broad range of this is what we look for. And if it fits our criteria, this is what we're going to buy. So let's talk about the operator first. How would you recommend someone vetting an operator?
Yeah, I think the biggest thing is experience, right? You need to understand their experience, the breadth of their team, and how have they done during, the last 5 to 10 years have been golden times for real estate. And so much like the tech bubble, so when the dot-com crisis, I was in residency at the time, and I remember, everyone was a genius because all you had to do was invest in any company that said .com after it, and your dollar became $2 tomorrow, right?
Pets.com, yep.
Yeah, and everybody was a genius. And so then you got to think about, well, were they really a genius, or were they just riding that wave of the market? So was their success related to their metrics and their model, or was it just related to the market? And so I think you're starting to see a little bit of that in the real estate market right now, because everything's been so hot, and everybody, who hasn't made money in real estate in the last 5 or 10 years. And so if you go just purely based upon performance, you have the risk of assuming that somebody has done well because of their model and their experience, as opposed to them just riding the market wave. And so it's important to kind of see, well, how have they done during a down market? And if they've never experienced a downturn before, that would be a red flag to me. So my biggest advice to people who want to get involved in real estate is to kind of look at the sponsor, see how they have performed in good times and bad times. What is their experience? Do they have any kind of marks on their record? And you certainly want to look into that, and how levered they are, how disciplined are they in terms of their financing, et cetera. So people don't often ask about that, but always ask about their debt, because we always want to be somewhat levered to increase our returns, but you don't want to be over levered. So it's a balancing act, and how operators structure their debt is a key factor that I think a lot of times doesn't get talked about as nearly as much.
How does someone go about learning that? Because a lot of it is in the details too. I've invested in a number of syndications, and we always look at the debt, and it's like if they have this floating debt, which it was 3 point whatever before, it was all great, but now it could be 8. And so what they have to do to protect themselves is they buy caps to it.
Right.
But then someone, if they don't know to ask that question, and they have this total 80% debt with this huge floating rate that wipes out their cash flow, it could go upside down, right? So how does someone, once you do it, you kind of know it, but I don't know, what resources, or where do you direct people if they want to learn kind of more about that underwriting process as an investor?
I think the biggest thing is to ask other investors who've done this before you. So that's what I did. I learned this business over the last 17, 18 years by, I read a lot of books and listened to podcasts and that kind of stuff. But there's only so much you can learn from reading and listening to podcasts. Ultimately, mentors and people who have a little bit more gray hair than you, who've experienced good times and bad times, can share with you lessons. It's kind of like, when you were a kid, your grandparents used to talk about the stories about when they were kids, and you're like, oh yeah, you should roll your eyes. But as you get more seasoned, you understand, man, they provided some wisdom about experiences that maybe you have not experienced. So, you can certainly learn from your mistakes, but you can also leverage the mistakes of your tribe. And so I never underestimate the value of listening to people who have crossed your path before. And so I hope that answers your question,
Yep.
Brian.
Yeah, that's great. That's a great one. Cause that's how I've learned. We mentioned this earlier, but I joined this group called GoBundance, which is this entrepreneurial group. And there's a lot of guys in real estate, and actually most of the deals I've invested in are from guys in that group. But that's how I've learned, because I've, been alongside other investors, and then the guys who run it, like you, who then, will kind of open up the Komodo in a sense and kind of give an idea of what the business is like and show real returns. And then they can show track record. These are like X amount of deals we've done. And, then you learn some of these things to say, hey, this is like a good quality, and hey, this is a bad quality. But a lot of it's the average of the people you're with. And if you're not happy with the room you're in, you just got to find a new room. And for some people it's GoBundance, for some people it's other, obviously Tiger 21, if you can net worth can hit that high, and there's other groups as well. So
yeah, absolutely. And I think the key thing is, as I was transitioning more and more to real estate, I really used a lot of my surgical career to kind of take some parallels about, in surgery, we really kind of go from one landmark to another landmark and kind of go in that graduated fashion, like we talked about in residency. And really just tried to apply the same principles that I used in my surgical training and my surgical practice to real estate investing. And I kind of realized, man, there's a lot of parallels, different industries, but a lot of parallels in terms of how you progress across a continuum of knowledge and experience.
Yep. And it's kind of the thing too, once you get more knowledge and experience, even for me, if I look at a deal within like a couple minutes, I can make a decision. Hey, is this thing worth investigating, or is this like total junk? And lately for me, and maybe you could speak to this, is like looking at the asset class. And even as we get this downturn, the price that some of these things want to sell at, like they're buying new construction deals at like a 4 cap or something. And then the plans to sell it at a 4.7 in like 3 years. And it's like, if interest rates are 6, you can't sell something for 4. But even that, like, to me, that's like a no-go, versus you look at these other deals that are maybe probably more like you do, where they're value add in the middle of the country. And there's like, rents are $700 and the plans to get them to $800. And it's like, that can get us a return that we desire. And so it's a lot of times I'm looking at like the business plan of the deal and just like, does this thing make sense to me or not? And a lot of times it don't even make sense. I don't even go any further. I don't know. You got any thoughts on all that?
I think the thing that I think most investors, active or passive investors, should really look at when they're looking at a syndication is really the MSA and the market, the MSA and the submarket, because real estate essentially is a people's sport, right? So people have to be moving to that area, and so where people move, where the jobs are, where it's a business-friendly climate, where it's those kinds of things, where the taxes are appropriate, et cetera. So you gotta study the MSA, and then you study the operator. Usually, if you get those two variables right, you've got somebody who's got some experience, who's honest, and has skin in the game, just like you have skin in the game, and they're investing in markets that have good demographic tailwinds that you can follow. A rising tide raises all ships. And if you're a long-term holder in those specific markets with financial discipline and not being overly levered, and have stress tested your model, anything can happen, but that's 99% of the battle right there. Like 4 variables, the 2 key being the MSA, the submarket, the MSA and the submarket together, and the operator. Those 2 probably have 90% of it. The remaining 9% is some of these other things we talked about.
And what's your business plan? Is it the sell in 5 to 7 years, or is it kind of the refinance, get the capital back, and just hold these things to cash flow? What is your plan?
Personally, I tell most other peers that are in our boat that are really looking for passive income that allows them to be able to practice medicine if they want to, and on their own terms, and take a vacation whenever they want to take a vacation, or attend their kids' soccer game at 5 o'clock if it happens to be at 5 o'clock, or donate to their favorite charities and be philanthropic and make a difference in this world, and have time for hobbies that they've never had time for before. So I think passive income is the way to do that. And so, personally, for most of our investors, it's generating the most amount of passive income. And so the way you do that, we humbly believe that if you can find a very safe, secure place and generate tax advantage passive income, and then as you make improvements to the asset, harvest some of that equity through either a refinance or a 1031, where you roll over those gains, and you essentially increase your basis in which to generate more passive income. So I'll give you an example. So I invested in a property in San Antonio about 4 or 5 years ago, and through various demographic cycles and operational improvements, the value of my equity had doubled, and so we transitioned that equity into a new asset. And so let's say I was getting 4 to 5% cash on cash every year on a tax deferred basis. Well, now because I've doubled that equity, I get 4 to 5% on the higher amount. So it's essentially 10%.
Okay.
10%
Okay.
of my original
cash.
My original cash in a tax deferred fashion. And you keep doing that over and over again. It's been commented that, time value of money and compound interest are like the eighth wonder of the world.
Yeah, right.
And yeah, it's just amazing, because then all of a sudden you keep rolling that over on a tax deferred basis, and pretty soon you've got, passive income that exceeds your monthly expenses. And You're like, man, I can do whatever I want. I can work if I want to work. I can donate to my favorite charity if I want to donate to my favorite charity. I can take a vacation if I want to. I can attend my kid's soccer game. I can focus on my health and focus on my family and build better bonds and build better relationships within my community. I mean, it's highly, highly addictive to be free.
Yep. That's awesome. Well, it's awesome what you're doing to help other kind of physicians too, we can't get in today, but it's a very stressful job, right? That's ever changing, probably regulations and everything that's going on. And so, like you said, if we can give them that passive income and the freedom, and then they can probably live a happier and probably more productive and, life and profession, which is, we all benefit from. So.
And it benefits the community, because think about it as if you were a patient, if I'm a patient, I would love to have my surgeon operating on me purely because they love the craft of surgery and not to feed their family. I mean, I just think the amount of empathetic, compassionate care that I could be delivered as a patient would be much better with a financially free
choices rather than, trying to work as many hours as they can or as many surgeries as they can do to hit the number they want to hit and then pay all these taxes on it too. So, anyway, it's interesting and it's awesome. So where can listeners connect if they're interested in learning more about you, or if they're interested in investing, or, just educating, for you to educate them, that kind of thing?
Yeah, absolutely. So we recorded a webinar recently that kind of gives you an overview of our unique opportunity. It's www.aptaproperties.com/webinar.
Okay.
It's APTA properties plural /webinar. And we're also have a new ebook coming out called the Smart Surgeon's Guide to Financial Freedom. They can email us at info@aptaproperties.com if they'd like a copy of that as well.
Awesome. Cool. And we'll link all that up too in the show notes, so you can just click the button and make it easy. And cool. I appreciate you coming on and sharing your story. And like I said, it's pretty inspirational and pretty cool what you've done and what you've built. And, I'll be excited to kind of watch you continue to build. I'm sure you're not done raising money and making this a pretty big company. So it's pretty cool.
Yeah. And thank you so much for everything you do, Brian. I think spreading the word about entrepreneurship and growing people's businesses, that's really, as a son of an immigrant, I was actually born in India myself. I think this is still a land of opportunity, and entrepreneurship is the unique aspect of our culture that I appreciate guys like you spreading the word about.
Awesome. Cool. It was great chatting with you, and I'm sure we'll stay in contact.
Thank you, Brian.
That's all we got for this episode with the Business with Beers podcast. One thing that would really help both us and other new potential listeners is to rate the show and leave a comment in iTunes, Stitcher, wherever you listen. Also, make sure to link up with me on your preferred social media platforms, LinkedIn, Instagram, Twitter, Facebook. You can find all my links at brianbeers.com. Please just share the podcast with anyone who you think might enjoy it. And until next time, remember to take the actions others won't, to live the life that others don't.